our jobs panel, Club for Growth president and former Congressman Dave McIntosh, and Lindsay Piegza, Stifel chief economist, and former Council of Economic Advisors chairman and Harvard Kennedy School professor Jason Furman is with us. Let's, I mean, with that ADP number, I'm just wondering, Lindsay, what are you thinking? I mean, can it be off by 150,000 jobs?
I know the market is looking for a relatively strong number, but I do think that we're going to see the risk of the downside. I think we see a number coming in closer to 125. And as you mentioned, that ADP number was pretty ugly. So we could see a payrolls number less than 100,000. Now, again, our official forecast is 125. But I do think that the risk to the market is we see a weaker than expected number, well below the trend pace of 170 as we have going into this morning's report.
Joe, we're still actually much more optimistic than that. We're at the 200,000 number. But the reason is I think you're seeing the continued strong GDP growth, and the tariff problem isn't yet impacting the employment number. It's more affecting supply chain questions for the large corporations. So I think the ADP probably overestimated in April, underestimated in May. If you average them out, it's not that inconsistent with what the real numbers are going to be.
Hey, Jason, is it possible a bad number is not necessarily a slowing economy, but just the difficulty finding qualified people and just the shrinking availability of candidates? Is that part of your equation?
Yeah, you know, we're averaging about 200,000 jobs a month this year. We had a lot more than that last month, obviously. If we have less than that this month, that'll be absolutely fine. At some point, and it keeps being after I think it's going to be, you know, we're going to have to slow down because you're going to have a hard time finding people. What I'm more worried about right now is that wage growth, nominal wage growth, seems to have stalled out. And if that's the case, I think that would be the more worrying for the sake of the economy, probably not for the sake of the markets, though.
Have your recession sensors gone off more recently in the last couple of weeks? Jason, are you in that camp? Have you been surprised by how quickly we're ready to? I mean, we go from Goldilocks and Nirvana to, you know, to 1920. We can do it in the blink of an eye these days.
Oh, there's nothing in the data that would make you worried. But if you're talking about a recession, you want to look forward. And there were some big policy changes announced in the last couple of weeks, and they should lead us to revise our forecast and revise it down. Even if we did Mexico, that shouldn't be enough to put us into a recession, but it certainly raises the odds.
What do you think, Lindsay?
I think there's plenty in the data to make us concerned, particularly looking at the consumer. We see traditional discretionary purchases trending negative in 3 of the last 5 months, with the latest April report down 0.2%. If the consumer is not happy and healthy out in the marketplace, that's a pretty big red flag that the economy is beginning to lose momentum. Also, when we look at business investment, we also see that corporations are starting to pull back. Now, it's still trending positive, but it's that second derivative or a loss of momentum. Business is signaling that they're less confident that the recovery will be perpetuated through the end of the year. And this is exactly what we saw in the first quarter GDP report. Top line number, very impressive, but consumption down to a 4-quarter low, business investment down to a 2-quarter low. And then when we strip out government spending, inventories, and trade, we see that real final domestic sales was at a 6-year low. And that's a very good indicator of the underlying organic momentum in the economy. It's at a 6-year low.
Hey, Steve, we just heard from Stan Druckenmiller that this number is extremely important, not because he thinks it's a good economic indicator, but because he thinks it will signal what the Fed will do next.
I think that's possible. I maintain 2 things, and I've been pretty strong on both of these. June is too soon, and the market is overall too aggressive in baking in rate cuts.
I thought July.
I think July is possible for a turnaround if you get a weak number and other confirmation. Remember, the Fed doesn't believe that job growth, and I say this believe, the Fed's estimate is that job growth should be no more than 80 or 100,000. And that is to take care of the entrance to the workforce. The idea that it's been higher and stronger is a measure to them of coming eventual tightness in the labor market, which we keep waiting for a bit like Godot, and it never happens. We keep finding workers, although the unemployment rate has been down, so that's a sign that indeed we are getting to a point. Whether or not that leads to inflation, I think the Fed is a little less concerned about that now than it ever was. So I think July is certainly a possibility. I think what would happen was, if you get a weak report and other signals of weakness, the Fed would signal a change in policy in June and deliver it in July.
Do you think the Fed, I mean, who knows what the preferences are, but you mentioned John Williams, right? There's this instinct they really would prefer, if they could, to be on hold and just wait and see if does a strong number today give them that clearance? I guess it depends.
To be on hold.
Them that leash.
Yeah, I think it does, and I think that's where they want to be. I think there are some people who even want to be a little bit tighter. But they deal with the reality of inflation not being at their target. I think there are some on the Fed on the other side who actually want to cut rates simply because of the inflation issue. And then you layer in this tariff issue, and Clarida was very clear with me on Tuesday. He said, how do you think about this? He goes, one-time rise in the price level, I address the weakness. And I think that's more or less Fed consensus.
I think the Fed's been reacting to the market in a way that is unusual. I mean, what they're doing is signaling to people this volatility, we're watching it, and you're going to be okay. In the end, I think Steve's right. It'll be the inflation number that drives what the real policy choice is that they make on this.
Had a great discussion with Druckenmiller about inflation. Did you see some of that?
Did.
Because earlier,